And I just lost like 3 speed chess games in a row. So I'm in a really foul mood. I don't know how that's going to affect tonight. It could get ugly. I don't know. It wasn't pretty, though. In fairness, I resigned the last one because it wasn't over yet and it was time to start the show. And I didn't feel like, I could keep you guys waiting. By the way, on my way down to the basement, which is where I recorded this thing, my niece is visiting. My wife says, "So what are you going to talk about tonight?" And I said, "Well, it's really sexy stuff. We're going to talk about how the rate of inflation affects the 4% rule." I don't know. They didn't really seem too excited about that. I don't know. Thanks, Jeffrey, for the thumbs up. So that's what we're going to talk about, at least for the first few minutes. And then, you guys can ask me whatever you want. By the way, speaking of inflation, interest rates on savings keep going up. I mean, of course, they're well below inflation. But the latest that I can find in terms of, something that, let me just pull this up in a different screen here for a second. I've got too many tabs open. Let's do a new window. Here we go. There it is. The best I can find with no strings attached is UFB, which I think is a subsidiary of Axos Bank. Both their savings account and their money market is at 151. So I guess they've beaten out Basque Bank by 1 basis point. I'm not sure. I'm not really sure how much that matters, but that's the best I can find. And, if you guys have better, leave it in the chat. Let me know. John says Ally is up to 0.9. Yeah. There's a lot of sort of the well-known online banks are at 0.9, 0.8, 0.85. So anyway, 151 is the best I can find. All right. So I want to start off. I've been thinking a lot about the 4% rule. I often even thought maybe I should write a book on nothing but withdrawal strategies in retirement. That's sort of the pros and cons of all the different strategies. I don't know. Would anyone buy that book? I'm not even sure my mom would buy it. Anyway, so remember the 4% rule. Bill Bengen didn't really set out to create what we know as the 4% rule. He had actually just become a financial advisor a couple of years earlier. He'd moved his family to Southern California. He was writing this paper, and the idea was to simply point out that the sequence of returns risk, and that's just a fancy way of saying the following. Imagine 2 different 30-year retirements, and let's assume that the average rate of return on their investments across the 30-year periods are the same, whatever, 8%, 9%, whatever the average is. And we can even assume inflation, an average. We have an average. Obviously, if we just use averages, well, then we get the same results when we do the analysis to see if either retiree will run out of money, right? Because we're using the exact same average rate of return, the exact same inflation rate. What Bill Bengen set out to show was that, that's not the real world. The stock market doesn't average 10% each and every, it's not a 10% return each and every year, as we well know. So his point was, look, if in retirement A, the bad years happen early in the retirement, and then the good years happen such that it averages out to whatever, 9%, 10%, whatever it is. And in retirement B, you get the good years first and then the bad years. That makes a huge difference on outcomes, meaning do you run out of money or not? Now, what do you do about that? How do we, okay, great. It's like, great, Rob, appreciate it. Sequence of returns risk. I get it. I can't control the markets. I can't control inflation. So now what do I do? Well, Bill Bengen's approach in his paper is really just one solution. And I think it's probably not even close to the best solution. Again, I don't think his point was to try to solve the sequence of returns risk. Of course, I haven't actually spoken to him. I'm going to try to get him on the show if I can figure out how to contact him. Anyway, I think his point was simply to say sequence of returns risk, it's a big hairy deal. It's a big hairy meatball in the retirement planning. But one way to deal with it, and remember, his withdrawal strategy was take out some percentage. We don't know what that's going to be, but some percentage in year one. And then for every subsequent year in retirement, just whatever that amount turns out to be, adjust it for inflation, right? That was his approach. Well, That's just one of dozens and dozens of different strategies for withdrawing money and calculating how much you can take out each year. It also happens to be the single worst approach, I think I'm saying it right, when it comes to sequence of returns risk. In other words, if you want to expose yourself to as much sequence of returns risk as you possibly can, you would start with the percentage. Following the first year, you would ignore the market, you would ignore the balance in your portfolio, and you would simply adjust for inflation every single year blindly. If inflation's 12%, you increase your withdrawals by 12%. And that's true if the market drops by 20%. Doesn't matter, you just blindly do it. Well, that really exposes you to significant sequence of returns risk for obvious reasons. And so how did Bill Bengen deal with that in his paper? He said, well, here's what we're going to do. We're going to look at retirements going on. He went all the way back to 1926. Others have taken it all the way back to 1871. And we're going to find the absolute worst sequence of risks situation that's ever happened in, modern history. Now we've gone back about 150 years. And what's the withdrawal rate that we can take out in year one, such that even assuming the worst case scenario, our money will still last 30 years. And that was where you get 4%, right? Most years, well, in fact, all years other than the worst time was the late 1960s. All years were better than that. You could take out 5, 6, 7. There were some years you could take out 10%. Now you might be saying, well, wouldn't it be nice if we kind of knew ahead of time? I mean, no, maybe we can't predict to the last decimal how things are going to turn out. But I mean, can we get some sense as to just how, are we retiring in a period that's similar to the late 1960s, where our withdrawal rate probably needs to start somewhere around 4%, or I don't know. I mean, maybe we're retiring, in a time when we could take out 8% in year one. Wouldn't that be nice? Well, there have been some analysis of that. Michael Kitces has done some research on that point. One of the things he looked at was stock market valuations. And what's the relationship between stock market valuations? And I believe he used the Shiller PE, which takes earnings over the last 10 years and adjusts them for inflation and uses that in the PE analysis rather than just say the last year of earnings. And what he concluded was when valuations are high, and I think his top category was something like a PE of 25. Some of you already know where this is going, and it ain't pretty. Here's the Shiller PE. We're currently at 28, right? That's this number right here. So what Kitces would say is, given this valuation, we're probably in an environment now, history would probably tell us 4% is about all you want to take out. If you're going to, again, that's if you're going to follow the Bill Bengen approach, take out a certain percentage in year one and then just blindly, regardless of what's going on in the real world, blindly increase it by inflation every year. Yeah, if we were down here, if we were in some lower valuation, of course, if we were down there, we'd be miserable, right? I mean, this is no fun time to live through. But if we were down in those low areas, don't have to be all the way down at the bottom, you're more likely to be able to take out a higher percentage. Now, what Bill Bengen has said since then is Kitces' work was great, but we do also need to think of inflation. Inflation matters. Well, inflation and PEs, predicting future inflation. I mean, it's one thing to look at PEs and say, well, we're at all-time highs, so we don't know when, but it's going to come down at some point. Or we're at all-time lows, we don't know when, but it's probably going to go up here at some point. You could argue against that, I suppose, but I mean, in any event, with inflation, it's trickier. But Bill Bengen's point was we got to look at inflation too. And inflation doesn't look so great right now. Of course, what we don't know is how long inflation will last. So the point I want to make is point number one. I appreciate your patience. There's still a few people watching. Is that the whole 4% rule and the whole sequence of returns risk that leads to the 4% rule hinges on the approach that Bill Bengen took, which was to take out a set percentage in year one and adjust it for inflation no matter what's going on. And the reason the initial withdrawal rate is so low is because he wanted to account for the worst possible scenario. Now, of course, what that leads to in most cases is folks having far more money than in their accounts than they started with in retirement. Not every time, though. See, that's the trick. I mean, sometimes you've got 6 times what you started with, because remember, you're basically using the worst case scenario, and you're using the worst case scenario because, again, once you start down this path under the Bill Bengen approach, you don't ever make any mid-course corrections. I don't care if the market has fallen off a cliff and inflation's 27%. Okay, it hasn't been 27%, but the point is, doesn't matter. You're going to just blindly increase your distributions every year. You can probably tell from my tone that I think that's a terrible way to approach retirement planning. Now, I by the way, that's not a criticism of Bill Bengen's paper at all, but it is saying the Bill Bengen's paper had a purpose. It wasn't necessarily for retirees to follow it as a way to determine how much you should take out every year. And in fact, I've yet to meet a retiree or someone planning to retire who does that, who takes out money the Bill Bengen 1994 paper way. And what I think happens in most cases, we don't follow a strict formula, the kind of formulas you'll read in papers about all of this, or whether Michael Kitces wrote it, Wade Fowles done work, Guyton Klinger are two guys that have done a lot of work on this. I think what most people probably do is they're very conservative. When the market's down, they don't spend as much. When inflation's high, they cut back. I think that's it's almost like just a gut feel approach. But the point is, it's dynamic. It's dynamic, meaning it changes from year to year and in ways that can actually not keep up with inflation, right? Because remember, Bill Bengen's, the way he did it, you keep up with inflation. You can use guardrails. Actually, a viewer emailed me about guardrails. I want to do a separate video on guardrails, but we've talked about the one where maybe you start at a 5% withdrawal rate and you adjust it for inflation, but within limits. You never adjust it where your distribution would be more than 6% of your portfolio, or that would prevent you from just blindly increasing by inflation in a really bad market. Of course, that would mean you have to cut back, but you start with a higher percentage rate because you're willing to make those changes midstream. One of the things that I'd like to either find or build is a really good calculator that allows you to input all these different sort of withdrawal strategies. And there are calculators out there. I've shown you some, but none that do exactly what I want them to do. Of course, that's just in a long list of things I want to do. So where does that leave us now? Well, I mean, inflation's what, 8.6%? I think the big question really is, what's the next year, the next 2-3 years look like? I'm not at all convinced that inflation will stay at this level. If I were guessing, I think inflation will moderate. Now, I don't know what that means exactly, and I don't know when. But I would be surprised if by the end of the year, we're still at 8.6%. Now, that's just a guess. I'm not changing my investment strategy based on that belief. And all the times I've predicted things like this, I've gotten them horribly wrong. So you should keep that in mind. But I do think, so if I were following the 4% rule, I might be comfortable taking an inflation adjustment this year, but not 2, 3, 4, 5 years in a row. Now, keep in mind that the 4% rule was based on, as I said, the worst case was retiring in the late 1960s. Inflation was 6 to 12% for over a decade. So it was ugly for a really long time. We're not even close. I mean, of course, I guess that could happen, right? I guess who knows? Maybe we'll be at 8+% for the next decade. If we are, the 4% rule will likely become, I don't know, the 3.9% rule. But I think having some sort of dynamic approach to your spending strategy in retirement, I think it just fits most people's personality, how we live. It allows us to make mid-course corrections. And that, in turn, I think requires some flexibility in your budget. I personally would not retire if I needed to take out 4 or 5% just to survive. There was no fluff in that budget. That was just to feed myself and my family and pay the rent and keep the lights on. I wouldn't retire. I might retire from my main job and get a part-time job, but if I were cutting it that close, personally, I wouldn't retire. Now, if if I had to live off 3%, then I'd be more comfortable retiring. Even if I'm going to start out spending 4 or 4.5 or whatever, depending on how willing I am and able I am to change my withdrawals. And there are different strategies. One is you might adjust for inflation, but not when the market's down. So if in a down market, you'd skip an inflation adjustment, or maybe you'd severely limit it. Of course, you'd have to be able to see your spending fluctuate a little bit. So, okay. That's all I got to say. Now we can answer your questions. Someone says a wicked echo is happening. I don't know. Hopefully not. Oh, no, it's fixed. Oh, good. All right. First question. From Steve. Who do I complain to at Vanguard when my in-kind equity transfer from Merrill Lynch is taking more than 2 months? That's bizarre. I can't understand why that would be. If you don't have an existing, like if you have an existing Vanguard account, depending on how much you have there, you may have a representative that can help you. If not, I would call them, obviously, and they have a department that handles this sort of thing. I'm trying to think if I've ever done I've done an in-kind transfer away from Vanguard recently, as a matter of fact. I had no issues. I don't think I've ever done an in-kind transfer to Vanguard. So, but beyond just calling the main number, Steve, I don't have any other guidance, but that's not good. 2 months it's ridiculous. But I can't even understand why that would be. So I don't know. That probably wasn't very helpful, but there you go. Sergio, assuming a 40+ year time horizon, would an investment with a large drawdown be opportunistic? For example, large growth versus large cap. Not talking about, I'm not sure what you mean. Would an investment with a large drawdown? Rephrase that for me if you can. I'm not sure what you mean by that. Maybe I'm tired. Maybe the losses in speed chess have still clouded my mind. It could be. This is a good question. When we look at the price history of a stock or ETF, does it include the dividend in the chart history? Is it just price? So it depends what you're looking at, but normally, like if you look at price, it's just the price, right? But you can find returns that include the dividend reinvested. But it's a good point. You definitely want to understand what you're looking at, and they will tell you. So for example, we've looked at this before, but I'll just show you an example. This is from Stern's Business School. Whoops, that's not what I wanted. Here it is. So they will show you, like they've got the S&P 500 returns here, and you can see it includes dividends. I thought they showed it without dividends, but maybe they don't. This includes dividends as well over here. So, whoops, there we go. But yeah, a lot of times you'll see, like if we go to, I think if you just Google like S&P 500 returns by year, you get this, I think it's slick charts. And I don't think this includes dividends. Well, we can look at it. We can find out, right? So for 2021, they've got 2871 right here. That's interesting. Stern's got 2847, and that includes dividends. So someone's wrong. Oh, it's total. They do include dividends. So I don't know why they've got two different numbers. But in any event, you have to know that. I mean, you have to look at whatever data they're providing you. Yep, there you go. 2-year Treasury, 3%. Now it's a 2-year, right? So there's some interest rate risk. I mean, it's not significant, but this is an interesting question. Does BND, which is a total U.S. bond market fund, hedge against inflation? Would I be better off just keeping it as a 2-fund portfolio? Well, those are 2 different questions. BND doesn't hedge against inflation. I mean, it doesn't invest in tips, for example. It does buy and sell bonds, obviously. And over time, I think if your time horizon is longer than the duration as an investor, you'll be fine. But no, I wouldn't view that as a hedge against inflation. By the way, someone emailed me about the Vanguard Balanced Fund that I mentioned last week, which includes basically VTI and BND. That's not how it's constructed, but that's basically what's in it. And they pointed out that the turnover ratio was very high. The turnover ratio is what percentage of a fund's assets are sort of bought and sold every year. And if we look at it, I'll pull it up on Morningstar here if I can find it. So here it is. And you find the turnover ratio under portfolio. And if you come down to the bottom, here it is. So this is 35%. If we were to look at say VTI, total stock market ETF, it's going to be much lower than that, 4%, right? This is relevant for a number of reasons, by the way, that includes, let me raise that a bit, there we go, that includes could affect taxes, could affect transaction costs of a fund. It's one of the, I think generally the benefits of an index fund, their turnover ratios tend to be lower than actively managed funds. But what I want to show you relevant to bonds is if we go to BND, right? This is Vanguard, total bond market index fund. And if we go to portfolio, you're going to see a much higher turnover ratio, 69%. The thing is, that's very normal for a bond fund. Look, they got over 17,000 bonds. And as bonds mature, they're selling and buying to stay within whatever sort of interest rate risk parameters. I mean, in this case, they're just tracking the Bloomberg U.S. Aggregate Bond Index. So because the balanced fund has about 40% of bonds, that's where you're getting all your turnover. It's not really unusual. Anyway, so but should you go to a 2-fund portfolio? I guess what you mean by that is get rid of bonds. I personally, I can only answer that from my perspective. I wouldn't get rid of bonds just because of inflation. For starters, you could always put some in tips if you want protection from inflation. But again, BND has a duration of what, 6 or 7? Oh, here it is, 6.75 right here. So if you're a long-term investor, meaning longer than that, you could lose money, as we've seen, but over time, the higher yields that you'll be getting will make up for those losses. You're not going to get rich quick on a bond fund like this, but that's not really its purpose, right? So, but whether you should have bonds and how much, that depends on a lot of factors: your time horizon, your risk tolerance, your other factors relating to your finances, your level of debt. I can tell you what from last week. I bought into the Vanguard Balanced Fund, which is 40% in bonds, like the kind of bonds that BND holds. So anyway, all right. Oh, this is tough. So how can I figure cost basis on fund purchase 30 years ago? Fund only tracks from 2012, bought early. I don't know, and I don't know what you do about it. If I were in that situation, I just call a tax advisor. But unless I can talk to the fund provider, but you may not even hold the fund with them. I don't know where you hold it, what fund it is, but I've had folks ask me this from time to time, and I've never had a good answer. Maybe there is one. I just don't know what it is. Boy, I feel like I'm striking out tonight. I don't know. See, I'm telling you, those speed chess games. Maybe I should pause the show and play another game, try to get back on my game here. All right. Here's a good question from TD55. Got a bunch of funds. Well, not a bunch, 4. 5, I guess. How many ETFs should I have? Also, would you make the 500 index your main investment in this portfolio? Well, my view is you should have as few funds as you can while still meeting your investment objective. It could be as few as 1, right? You could use a target date retirement fund or something similar to a Vanguard Life Strategy fund, which is, it's basically an asset allocation fund, right? iShares, they have their core portfolio that we've looked at in the past. Fidelity has some. Of course, you've got life strategy funds, so you could do that. You could go with 2 funds, right? You could do a VT, which is total global stock allocation, and 1 bond fund if you're going to have bonds. If you want to decide on the amount of allocation to international stocks and U.S. stocks, you'd take VT. Instead of buying that, you'd get like a VXUS for international, which is a Vanguard fund. You could do Fidelity, or I'm just using that as an example, and VTI for U.S. stocks. So my view is as few as you can get away with. And by the way, if you're just I don't know where you are in your investing journey, TD 55, I don't know, maybe you're 55, I don't know. When you're just starting out, maybe you open up a Roth, it doesn't seem like a big deal, but fast forward 30 years and you've got, 2 Roths, if you're married, 2 Roths, 2 rollovers, maybe you've got an inherited, you've got a couple HSAs, you got a taxable account, and all of a sudden you got funds everywhere. It's a real hassle to deal with. Now, I think the Fidelity S&P 500 index fund's a great fund. I think it could certainly be a core of a portfolio. Whether it should be for you, I really can't answer. But we can look at the fund. So VGT is Vanguard's technology fund. So my approach to investing is generally not to use sector-specific funds. It's not that there's anything wrong with this fund. It's just that I generally don't want to bet on sectors. Now, I do have individual stocks, and some could argue that I've bet on financials. Fair enough. But I've never, I don't think, ever owned a sector fund. I mean, this is certainly a good fund if you want to overexpose your portfolio to technology. You just have to be prepared for this to lose a lot of money, not a lot, well, I guess, but underperform for long periods of time. That hasn't happened recently. Now it has, it obviously has this year. We can look at its performance. So it's down more than the S&P, but I mean, you look at the, this is the whole point of long-term, because you end up with years like that. But that might not happen for another decade or more. Who knows? Maybe it doesn't happen in our lifetime. That's sort of the problem. I mean, up until then, I guess 2017 was pretty strong. These were good years for sure. I mean, look at this, from 2012 to 21, it didn't have a down year. Now, what the future holds, I don't know. Guess we'll see what inflation and interest rates do. Okay, so that's VGT. VBR is, we've looked at this before, but let me pull it up. It's the small cap value. I like this fund a lot. I think I don't own this fund, but I have in the past. And, again, the whole point of tilting towards small cap value, the reason people recommend it is because historically that asset class has pretty much outperformed everything else over long periods of time, not the last decade, but over the last 50 years. I can show you. We'll go to Portfolio Visualizer, and we'll back test the US market and then small cap value. Whoops. And you can see 1.5 million for the market, 6.5 million for small cap value. That's when your money folds for sure, right? Anyway, of course, if we go year to year, so the market is red, right? And the small cap value is blue. Small cap value is actually done a little better this year, and it did better last year, but for a number of years, not as good. But I guess it's done okay. The question is going to be, what's the future hold? And I don't know. No idea. One of my concerns with asset classes that have done well historically is, do people then see that performance and rush in and raising prices and then decreasing the odds that future performance is going to be as good? I don't know that that's happened with small cap value, but all right. What else we got? VFH, is that health? Well, that's financials. So again, it's another sector. So if you think about this, so your Fidelity 500 fund is large cap blend. So your small cap value is definitely a diversifier. I mean, you could just do a total U.S. market, but if you've got an S&P 500 and you got a small cap value, pretty much right, no overlap there. But with the technology sector and the financial sector, and now an S&P 500, just so you know, there's a lot of overlap there. Doesn't make it a mistake. It's just, are you aware of the overlap and like have a reason for it? So maybe, I don't know, maybe you want to put 10% in financials, but I think you said equal amounts. I wouldn't personally, I'm not telling you what to do, but personally, I would not make that big of a bet on a specific sector. Yeah. All right. And is this real estate? Yeah. V&Q is Vanguard's REIT. Again, great fund. I've owned it. Probably personally wouldn't put 25 or 20, a fifth of my portfolio in it. I think I've always allocated about 10% to REITs. Although not now. It's changed for me a bit, but yeah. So I wouldn't put that big of bets personally on sectors. Look at this. My mom's wishing me happy Father's Day. Thanks, Mom. I wonder what she thinks about how inflation affects the 4% rule. She's probably thinking, where did I go wrong? I tried so hard. Okay. This is a good question. Dinesh. In Schwab video, you mentioned having cash reduces returns, but Buffett has 100 billion in cash and said Berkshire will continue to have substantial cash. Is it better to have some percent portfolio in cash? Well, Buffett doesn't know what he's doing. I mean, no, I'm just kidding. So you have to remember, you could think about his cash. He said it'll never go below a certain amount. That amount's gone up. At one point, he would never go below 20 billion. I think he raised it to 40 billion. But that's his emergency fund. I mean, it's a big emergency fund, but Berkshire's a big company. So that's his emergency fund. Remember, he's also, they are an insurer. So they have to be worried about the year when a lot of bad things happen all at once. So that's one of the reasons they hold a lot of cash. The other is he's waiting for good deals. He's not going to go out and invest it all just because he's got it, unless he can find great deals. So that's his approach. My point in the Schwab video was not that you shouldn't have any cash. You should obviously have cash you need to spend in the near future and an emergency fund. But why would I give it to a broker to hold inside an investment portfolio that's purportedly free, that ties up at least 6% of my money? That's the point, right? And that's why I've always been critical of Schwab's intelligent portfolios for that reason. So I hope that at least helps explain my perspective on all this. Josh, if you've got a long time to go before you need the money, you should hope that the markets crash even further. And I went through this. I remember being a young investor. I was at the law firm, and I remember joking with a colleague. We would put, get our paycheck, and so much would go into the 401k, whatever that, I don't remember what the amount was. And then by the time our next paycheck came around, our 401k balance had gone down by the amount of our previous contribution. It's like felt like we're just throwing money away. But that's the best thing that can happen for long-term investors. If you're not spending any of your, if you're not in retirement, taking out money once a year or whatever, you want it to go down. It'd be the best thing that can happen. What do we got here? Fabiano. I opened a SEP, realized after the fact that I can't really maximize it yet because the year is not over and I don't know how much I would make by the end of the year. Open a taxable or can I cancel? Well, if you haven't put anything in the SEP, you don't even have to cancel it. It's just like opening up an IRA and you put nothing in it. And you can wait until the end of the year and decide, have your accountant or however you do it, figure out your minimum contribution and make it just like you can with a regular IRA. I don't know if that helps, but that's what I do. I haven't put anything in my SEP this year. Thanks, Jeffrey. So Capital One 360 is at 90 bips. That's where I have our emergency fund. And it's interesting. You say, well, wait a minute, Rob. You're telling me you don't have it at like the 151? I don't. I can move it. I just don't. I don't know. I just don't. That doesn't make any sense, Rob. That's not logical. I know. I don't know what to tell you. That's one of the reasons, like, on that page I showed you where I track savings rates, that's, one approach to like the best online savings account or whatever would be to say, well, here's the number one. Doesn't matter who cares what Marcus is paying. It's not number one. But people, I don't know what motivates me not to switch, but people, they're comfortable where they are, or they want a brand that they've heard of. It doesn't matter that they're all FDIC insured, or they go to the website and they don't like the look of it. We all have our different reasons. They may not all be logical. I don't know. Okay. But I do track Capital One. Do I have the right, let's see, do I have them at 90? I don't. I have them at 80 bips. Yes, I do. It's okay. We can fix that while we're answering questions. We're going to multitask. Sergio, thank you. So what drives me crazy about the reviews on Amazon? Someone gave me a 3-star review. So it's got an average of like 4.6 or 4.7 out of 5. Someone gave me, here, I'll show it to you. Makes me want to cry. All right. Okay, so here it is, 4.6. Well, that's interesting. It's switched over. So I haven't looked. You can tell I don't look at these reviews real frequently. So you can see the number one review, or what do they call this? I don't know how they determine what a top review is, but is a 5-star. For the longest time, it was a 3-star. And the reason the person gave me a 3-star, I don't even remember what it was now. It's because I didn't cover something in the book, and the book wasn't about that. So I'm like, that seems unfair. But look, I got a 5-star at the top now. Good. All right. Anyway, thank you. I have a book that I want to write. I have several, but the one I think I'm going to write next is basically just how to invest worry-free. By worry-free, I mean how to invest and feel, confident that you're doing the right thing. I mean, we can also, I can sit down and describe the 3-fund portfolio to someone in 5 minutes. But describing it, I can even help them set it up, say at Vanguard or Fidelity or Betterment or M1 or wherever. But doing that is a lot different than actually putting your money to work and feeling comfortable you're doing the right thing, even when the market's crashing, unemployment's high. So that's what I think I want to do. Anyway, okay. I think you suggest keeping individual stocks to no more than 10% of total portfolio. Is that 10% an aggregate or discrete to each individual stock? For me, it's an aggregate. Although mine currently is closer to 20%, but that's because the stocks I've bought have done really well. Actually, I haven't checked. I don't know what the allocation is now. Maybe it's pretty bad. Let's see here. I'll tell you what it is, maybe. My individual stocks now comprise, drum roll, is that right? 22.45% of my portfolio. That's richer than I would like, but I'm not going to just go sell and incur incur capital gains just because it's an X percent. And they've all been down, but anyway. Okay, so yeah, it's an aggregate. Oh, I was doing Capital One 360. Let's get that updated so you guys get accurate information. There it goes. All right, it's updated. This is interesting. Buy today or wait for what the market does on Monday. Not timing it, just afraid there'll be a large discrepancy when the market opens just to drop it again. I don't know. It's interesting. I think it's Guy Spear, who is I don't know if he runs an investment firm where he invests your money. He's one that had lunch with Warren Buffett. By the way, did you see lunch with Warren Buffett went for $19,100,000 this past weekend? Anyway, he had lunch with Warren Buffett. I think it was in the 90s. He paid $600, $650, something like that. I've interviewed him. Great guy. I'm pretty sure he's the one that says he always trades after hours because he doesn't want market action to influence his decisions. I don't know. But, I don't. The only thing I do is try to avoid trading early in the day or at the end of the day if it's an ETF. I want to make sure, or at least I check the bid-ask spreads before I do, because they can get wonky early and late. Okay. Josh, what's the current PE of the stock market, and what's a good source on that, and what PE do you consider it to be fair or undervalued? Well, that second part is tricky, and I'll show you why. Bear with me. So we've got the Shiller PE. Remember, he takes 10 years of earnings and averages them adjusting for inflation. And here, the Shiller PE is 28. You can see down here the mean and the median, 17 and 16 roughly. So at least by that measure, we're a good deal above, the average. Right. So, but, and then this is the Shiller PE. We can look up, he's got just the PE. Oh, here we go. He's got just the regular PE ratio here. He has it at 18.57. By the way, I'm not at all convinced that the Shiller PE is a better measure of valuation. I'm not convinced of that. But in any event, so currently it's, it's above the average, but not crazy above the average, right? Here's the trick. You can't look at the PE in a vacuum because it's influenced by prevailing interest rates. So given our current interest rates, which are still historically low, I would say this is, reasonably valued. The trick is if interest rates go, if the 10, goes from whatever it is today, is it 3%? What's the 10-year Treasury yield? Here we go. 3.25. So if we snapped our fingers and it were 5%, the stock market value would go down. But given the relatively low yield, I think it's probably in the range of reasonable. And if interest rates continue to go up, though, it'll go down. The other thing to keep in mind is, and feel free to disagree with me on whether it's reasonably valued given interest rates, but regardless of whether it's reasonably valued or not, just because something's overvalued doesn't mean it won't go up more. And just because something's undervalued doesn't mean it won't go down more. But I would say it's roughly reasonably valued given interest rates, which is kind of not helpful, if I'm being totally honest. What's Bitcoin? It had a wild weekend. I think it's around 20 now. Yeah, 20,700. I don't own any Bitcoin. All right. That is so true. It was easier to be fearful when others are greedy. Okay, Mr. Dan. I believe you stated that you exited your iShares AOR fund. That is true. I didn't really change my my asset allocation, I just decided to use a different fund. It changed it a little, but that really not much, and that wasn't the purpose of the change. Anyway, I was thinking of possibly consolidating my 80-23 fund into AOA at some point. So just curious why you changed your mind. Okay, well, I went with the Vanguard balance, which is 7 basis points. AOR was 15. So that's one reason. I'm just double checking. It could have changed. I doubt it. No, so it's still 15. Oddly enough, I am more comfortable owning mutual funds than ETFs. That would go along the lines of why I still am earning 90 basis points on my savings accounts when I could earn more. Probably not logical. I've always been a little more comfortable with mutual funds than ETFs. But I cut my expense ratio by more than half. So that was the biggest reason. The other thing was, and I'm trying to remember here, the portfolio itself was much simpler for VBAIX. It's just basically US stock market and US bond funds. This one's a little more, this doesn't make it worse. You know, I don't know that I would say one is better or not, but you know, they've got, it was more for me to track with all of these funds. Now, one could say this complexity doesn't matter because all you have to do is buy the fund, right? Or whichever I share core fund meets your asset allocation. And I know I've still got the comment up there, but I'm gonna leave it up there, but I'll move it here best I can. So at one level, the complexity doesn't matter because, you know, all you do is invest your money in one fund. But I just preferred the simplicity of the Vanguard fund over all of this. But mainly it was the expense ratio. And when I invested in AOR, honestly, I didn't at the time. It was like, okay, I want to deal with this. I don't want to have. I'd moved it out of a more complex kind of arrangement, and that was good enough. And it was in a. These are in retirement accounts. I don't have to worry about taxes. And then, you know, a month or two went by, and I finally did the research. Found the one fund that I thought was great that you can only buy inside an HSA. Oh, well. But then, you know, the balance fund worked great for my purposes. Well, Vinyl, I think that's true. I will agree with you if you basically have a portfolio that covers the market. So yes, if you can live on 1% to 2%, which is what the market's basically paying, depending on your allocation, you know, exactly what kind of, you know, allocation you have. I think that's true. I mean, you can imagine a scenario that's so bad where it wouldn't be true, because, you know, companies can stop paying dividends. But by and large, if you've got sort of your standard portfolio, but, you know, when you read these articles where they say new fund 7.9% yield, you know, and people look at that and think, oh, I can just live on dividends and not worry about price, because there's no way a fund can pay you 8% dividend yield and have a total return that's anywhere near the S&P 500 long term. This can't happen. I'm sorry, it just doesn't work that way. By the way, if it did, what would happen? If there was some investment, some ETF, whatever, and it paid 8% yield, but its total return matched the S&P, or I don't know, given the 8% yield, let's say it was higher than the S&P, right? What would happen? People would buy it. Lots of people would buy it. Then what would happen? Price would go up. Then what would happen? Dividend yield would go down. So yeah, I agree with you. As long as you've got sort of a pretty standard, it doesn't have to be, you know, S&P 500 only. You might tilt a little towards value and increase your dividends a little bit, but you go far astray and start getting into 4, 5, 6, 8, 10% yields. I don't think that's a good way to go. Well, Jeff, I can't really answer that question for you. I would suggest you watch my 3-fund portfolio video, which kind of gives you my take on at least where to start. The key for you or one of them will be, when are you going to retire? When are you going to start spending the money you're investing? What's your time horizon? Do you have debt? Will the debt be paid off when you retire? Things like that. So, yeah. Okay, Sue says, I have enough in Social Security to pay all my monthly bills and have some money left over. I have 500,000 and no payments. I'm going to guess you mean no debt, I guess. I'm going to assume that. I'm 70. How's my situation? I don't know. It sounds pretty good to me. If I'm reading the question right, you've got no debt. Social Security, which is adjusted for inflation, right? That's important. How is Social Security? Do they use CPI for the elderly? What do they do? How is Social Security inflation calculated? I should know this, but yeah, CPIW. That's what they use. So you have CPIU for urban. That's sort of the CPI that I think when you hear the CPI number, that's what you normally hear. W is, I guess it's specifically just for Social Security. Oh, I see. No, that's not true. Oh, that's interesting. So CPIW is the Consumer Price Index for urban wage earners and clerical workers. All right, but hang on. What is CPIU? I should know all this. I'm actually going to be on an Ask Me Anything Zoom thing with new retirement. We're talking inflation, so I better know what I'm talking about. Yeah, it is urban. Yeah, so CPIU, that's what I thought. So Consumer Price Index for all urban consumers. I didn't realize the CPIW also included the word urban, but this is what they use for Social Security. So my point to all of that, Sue, is that your Social Security is adjusted for inflation, which is great. And you have no debt and $500,000 to boot. So on that, if you think about the 4% rule again, I had some qualifications on that at the start of the show, but that would be another 20 grand you could take out, right? In year one and adjust for inflation, but you don't even need that. As you've said, not only can you pay your bills, Social Security, you have money left over. So, obviously I don't know your whole situation, family, health, all, but no debt, cover all your expenses and then some with Social Security plus $500,000. That sounds pretty good to me. All right. This is a tricky question. So Christopher wants to know, would it be more effective to put my extra money in a traditional brokerage or towards taxes and a Roth conversion? 24% tax bracket now, anticipates same in retirement. Well, my instinct tells me I would do the Roth conversion. Some things to think about. You're going to have to pay that tax, right? We know that. Well, unless you died before you pulled the money out. Although inheriting a Roth is better than inheriting a traditional anyway. But let's put that aside. You're going to have to pay the tax at some point when you take the money out because you need it in retirement or because of required minimum distributions. So the point of a Roth conversion is basically to say, I'm going to pay the tax now. The nice thing is that as a general rule, the value of a Roth conversion goes up over time if you pay the tax on the conversion from outside the IRA, like you may do from your checking account or whatever. And I did a video on that a while ago, but I can show you the article. It's from Vanguard, and it's called the Better, BETR, break-even tax rate. I think is what that stands for, if I remember correctly. Yeah, break-even tax rate. And the point is, there's a couple of things that can, over time, make a Roth conversion even more and more valuable. But the big one is if you pay the taxes out of a taxable account. And conceptually, the way to think about that is, you've got 10,000 in a traditional and you're going to move it over to a Roth, and you got to pay the taxes. Let's say it's $2,500. If you pay it out of the IRA, putting aside 10% penalties if you're not 59 and a half, you obviously pay $2,500 to the government. You keep $7,500 in a Roth. And let's say you could have paid it out of a checking account, but you didn't. So you've got $2,500 in a checking account that you could then go invest, right? But by doing the Roth conversion and paying the taxes out of the checking account rather than investing it, the same $2,500 goes to the government, but you end up with 10,000, right? The full 10 grand in the Roth. So what's the net effect of those two different scenarios? Well, the net effect is you're taking the $2,500 that was in a checking account and putting it inside a Roth and then investing it as long as you want to, right? Tax-free, assuming you follow all the rules. So I personally would go with the Roth conversion. There could be other issues that I'm not thinking about. Keep in mind too that the tax bracket is not the only thing you've got to worry about, because you could still be in the same tax bracket, but could end up paying more taxes either at the conversion or when you take the money out of a traditional account if you don't convert, for other reasons. Like you do a conversion, it increases your income and you don't get Affordable Care Act subsidies, or you're receiving Social Security and you either take a conversion or maybe you're taking withdrawals from the traditional, and it could increase the amount of your Social Security that's subject to tax. So there's a lot of variables that can come into play here. But generally, yeah, I would probably do the conversion as my off-the-cuff best answer on the fly. There you go. But check out that article from Vanguard that kind of walks through it. I think it's more or less fairly straightforward to understand. Ish. Okay. All right, what else do we have? Lisa, she's asking the group. She's not asking me. I've been down the rabbit hole. Thoughts on whole universal life insurance for retirement cash flow? I will tell you, I'm going to give you my opinion. You didn't ask my opinion. You asked the group, but I'm going to give you my opinion anyway. A couple of problems. So you'll see salesmen and women, salespeople on TikTok, on YouTube, talking about how just absolutely incredible whole life, universal life insurance with cash value. It's just incredible that you get tax-free growth. And they'll even say they're much better than a Roth, IRA. There's some things, though, that they tend to leave out of their 2.5-minute TikTok video. So one is, to get all of the retirement benefits, you've got to buy permanent life insurance. There's two problems with permanent life insurance. One, almost no one needs it. That's problem one. Problem two is it's extremely expensive. That money would be, in 99%, maybe 99.9% of the time, would be far better off taking those premiums. If you need life insurance for some period of time, buying term life insurance, which is significantly cheaper, and investing the rest. So that's problem one. And they just skip over that. In fact, what they'll say is, hey, you get lifetime insurance. So you've got coverage, your family, you're protected. I mean, who doesn't want to be protected? I've yet to meet a 90-year-old with life insurance. You can tell it really toasts my buns. Anyway, then what I'll see a lot of them do is make these projections of what your value could be. And lurking in their calculations is leverage margin. They'll say it like it's a feature. You can borrow to invest more and increase your returns, and you can borrow at a low rate. But they don't ever show you what happens when you're borrowing at a low rate and the market's going down and you're still paying the interest. Leverage is great when everything's fine. When the wheels come off the market, people with a lot of leverage get destroyed. They get wiped out. They talk about how your investments will never go down. there's a floor, 0%. But what they don't talk about is that your upside's capped as well. And long term, you're going to end up not, in my opinion, not as good off, as well off as you would be if you just invested. And if you wanted some kind of security blanket beyond Social Security, something you could count on, then I would get a single premium, either an immediate annuity if you need the money now, or you get deferred, low cost. But what I'd really do, Lisa, before you do anything, is talk to an advisor who's not selling whole and universal life and get their opinion. All right. Well, this is from Yippee, and the question is a market cap weighted versus an equal weighted. And we've talked about this before, but I'll pull them up. See if I can do them side by side. Bear with me. All right. So what tickers did you use? Why is this not working? Here we go. What do we got? VFINX. Is that just a S&P? Oh, that's the Vanguard. Okay, Vanguard S&P 500. Here, I'll show you what I'm doing. Here it is. And we're going to compare that to an equal weighted, which RSP is a popular equal weighted ETF. And we'll go to the portfolio. And the first thing we can look at is average. So this is the S&P 500. It's a large cap blend, right? Here's the equal weighted. Well, they don't even have it in there. Come on, Vanguard. Well, let's do weight. Here we go. So you can see that whereas the S&P is heavily weighted to large cap, the equal weighted has got more distribution in the mid cap range, nothing in small cap. And if we looked at their top holdings, let me go all the way to the bottom. You can see that they all have roughly the same amount. They must, I'm guessing that they effectively rebalance this, I don't know, once a quarter, I'm not sure. But you can see the cap weighted, you know, boy, Apple's 6.5%, Microsoft's 5.8. When I was learning to invest, I was surprised to learn that the S&P 500 is cap weighted. This seemed wrong to me. It seemed like this made more sense. Isn't this more diversity? We're spreading our money around. But the point of a cap weighted index is that you're trying to mimic the market, right? And the market is not evenly distributed like this. That's not how the market works. People don't value all of these companies the same. Some are worth more. Some have more, you know, have attracted more capital. So the idea of a cap weighted index is to mirror how the market views all of these companies. And that gets some criticism from time to time, where people will complain that the top 10 companies are whatever percent of the total. But you know, you can look at history and see how the S&P 500 has performed. If I want to spread my money around more, you could go with a total stock market fund. Now that doesn't spread your money around significantly more than what you see in the S&P 500. But the other thing you could do is go with an S&P 500 and a mid-cap fund, if you wanted to, or a total stock market and a mid-cap or small cap. It's not that an equal weighted is bad per se. I just don't find it, for me, the way I want. If I want more diversity with more holdings in the mid and small cap, well, this doesn't have any small cap, but the mid cap and small cap asset classes, I'd rather just get funds that do that. And then I can control just how much I have in each. That's always been my approach. All right. So I get this question about once every 3 weeks, and each time I say, yes, I will, and I just haven't done it. So I'm going to do a review of Avantis this Friday. I'm going to publish it this Friday. I'm putting it on my calendar. Avantis funds review come hell or high water. Done. Sorry for the foul language. Okay. Here's from Mike. My wife and I, the wife and I are retiring next year. We plan to use our Social Security, a small pension, and a single premium immediate annuity to create a floor to cover expenses, and then draw 1 to 2% for discretionary spending. That's a very conservative approach. Just keep in mind, I'm sure you know this, Mike, the SPIA will not be adjusted for inflation. I don't know about your pension. I don't know. Are most pensions adjusted for inflation? I would think so, but I've never been the beneficiary of a pension. Aaron, is this true? I hear these comments that people are not happy with how CPI is calculated. I confess I'm not an expert on comparing how it was calculated. Has the calculation of CPI changed over time? Over the years, the methodology used to calculate the CPI has undergone numerous revisions. Huh. Well, if you want to read up on it, and Aaron, I don't have an opinion on this, but I'll trust your judgment, at least for now. I'll probably form an opinion at some point. Here it is, the Bureau of Labor Statistics, the original Consumer Price Index, CPI revision in 1940, improvements. Another revision, improvements made from 64 to 78. Well, here's 78. Maybe this is what you're talking about, comprehensive revision. Oh, they renamed CPIW. Yeah. Well, there you go. I don't know. Would it really be 18%? Like, I wonder if there's an analysis of what CPI would be based on older versions. 18%? Boy, it could be. I don't know. All right. Well, here's one person that hasn't had any issues with in-kind transfers with Vanguard. Thought I should put that up there since we had one earlier about trouble. That's the hard part. You can't recreate these issues. You have a bad experience. Is it typical? Is it an anomaly? Maybe they're having a bad day. I don't know. Well, Dave, I can tell you, so the question here is, what would make BND ETF go down further? Rising interest rates. If interest rates continue to go up, the value of BND will go down. Now, over time, it'll benefit from the higher yields, but that takes time. What factors would lead to investing in BND? I think BND is a good fund if you want just a well-diversified bond fund that invests in U.S. bonds. Keep in mind, it doesn't invest in TIPS. So you have no inflation protected bonds. Obviously, no ETF includes I bonds, but it doesn't include TIPS. So if you wanted some exposure to TIPS, which I do, you would have to have effectively 2 bond funds. Or if you were using BND, you would need 2 bond funds. So what I've done is taken 2 of our retirement accounts that just had the right amount of money in them, just per chance, and put them all in TIPS. And then I have VBAIX, whatever, the Vanguard Balanced Fund for the majority. So it doesn't give me the exact allocation of TIPS that I would choose if I had total control. But it's good enough. Yeah, if you run the right numbers, Fabiano, yeah. REITs can look good. I don't know what REITs you're looking at. I tend to use the Vanguard REIT index fund. One that's done really well over the years. I don't know how it's done this year. Let's look it up. We're going to go to Portfolio Visualizer. And the fund is just ticker O. Why is nothing coming up? Am I in the right? That's interesting. Well, let's put it in. Maybe it'll come up if I... Yeah, Realty Income Corporation. So this goes from 95. Let's compare it to, is it VNQ? Yeah. We'll compare it to that. And let's compare it to VU, which is just an S&P 500. Right? How have they done? Well, that's interesting. So Realty Income did not beat the S&P 500, but pretty handily beat the Vanguard REIT Index. Now, before I would get too excited about this, this is a much more focused fund. I mean, this is a fund of many, I don't know how many, but a lot of REITs. This is just one. It's like investing in an individual stock, but it has done well. And the other thing about it is, if you look up here, so blue is Realty Income, right? And in yellow is the S&P 500. Realty Income was beating the S&P 500 for long periods of time. It wasn't until after COVID, after the COVID market, and then it started to come back, that the S&P 500 really took off. And it's down this year. It's interesting. Realty Income is down a lot less. Look at that, only 3% this year. But of course, it didn't have as good a year last year, and it had a bad year in 2020, at least compared to Vanguard. Well, and compared to Vanguard's REIT. So anyway, I mean, there's definitely a place for REITs in a portfolio. You do get some REITs with like a total stock market fund, but it's only like 2 or 3%. I've never heard of NTSX. It's 90% S&P and 10% 6X leveraged bonds. So that's not my style. But look, you crazy people like to do all these crazy things with these wild funds. I mean, I'm happy to take a look-see. If I can get Morningstar to work. It's like not cooperating today. Why is that? I think it's trying to load a bunch of ads. Wisdom Tree U.S. Efficient Core Fund. So here it is. I'm trying to think. I'm trying to do the math here. Does that basically give you a 60-40 portfolio? Yeah, this is one of those deals where we need to go to the website. Gain enhanced exposure, not just exposure, but enhanced exposure. I know that because it says enhanced right there. To U.S. equities with added bond futures diversification to potentially lower volatility, used to help boost capital efficiency. So whenever they get creative like this, I get nervous. The expense ratio is not terrible for this kind of fund, 0.2. I wonder if this is effectively, if it gives you the sort of the equivalent of a 60-40 portfolio. NTSX equivalent. Oh. Well, according to Seeking Alpha, and I have no idea who wrote this, the 67% in NTSX should have the equivalent exposure of a 60-40 balanced fund, while the remaining 33 of your capital is freed up. Oh, this is a different use case. Well, I would need to dig into it, but my question to you would be, why that fund? I mean, if you want some bond exposure, why not just get bond exposure? I guess one could look at this, and we could do a back test where we said, let's see. We could do NTSX, right, at 100%. And then we could do BND at 40 and VU at 60. Whoops. This is probably not going to tell us anything helpful, but it could be fun. Oh, we get a whole 3 years of data. Not helpful. Well, Wisdom Tree clobbered it, but the standard deviation is a lot higher, so it's not giving us a 60-40 portfolio. I can tell you that right now. We would want to match the standard deviation, right? The volatility. We're still not there. Yeah. So this, I don't know what this is equivalent to, but it ain't a 60-40 portfolio, at least so far. See, I'm trying to get the standard deviation to be the same. It's no big deal that one investment outperforms another if its volatility is a lot higher, right? So maybe this is, well, it is a 90-10 fund, even though it uses leverage. It gets them close, but it gets the returns close. So I guess I don't know what the point of that fund would be. Plus, it's more expensive. But that's just a quick look at it. What do I know? It just took how long? So Clarice wants to know how long it took. I don't remember where I was sending it. I can't remember, but it just took a couple of days. It was quick. Well, I think Dave. So Dave's question is: VTI enough of a small cap tilt, or should you do VU S&P 500 and VBR? Both approaches I think are reasonable. Back in the day, I would have taken the second approach. Today, I want the simplicity. I go with VTI or VTSAX, mutual fund version. Which approach will outperform over the next 10, 20 years? I don't know. If I were betting, well, I don't know. I mean, historically, I would say VU and VBR, but who knows? So there's no better approach. The both are reasonable. Yeah. Have Fun wants to know what drove you to create Dough Roller. So this is a true story. So in 2005, I decided I was going to be debt free. That the best thing money can buy is financial freedom. That's when I didn't come up with that line, but that's when I decided it's better than a fancy car or a fancy watch. So that was 2005. I was still practicing law. 2007, I told my wife one day, I said, I'm kind of bored with the law practice. She said, well, get a hobby. And so my plan was to start woodworking. We had a woodworking shop in our old house that the previous owner had built. So it's like, well, clearly this is what I was meant to do. And I did. I bought some tools, built a workbench. I wasn't very good. Fortunately, I didn't lose any fingers. And as I was researching something about woodworking, I came across this website. It's not a very pretty website. Not that mine were very pretty or are. And you can see it hasn't been updated in a while, but I came across this website in 2007. And I thought, wow, this was just some person who built this website. I didn't know how. And started writing about personal finances. You can see they used to have a list of personal finance sites right here. That's, I guess, gone. And I just thought this would be so cool, and I probably won't lose a finger. So that's an added bonus. So I started Dough Roller in May of 2007, just to write about personal finance and investing. It wasn't a business, just a hobby. I knew I could make some money, and that interested me, but I didn't know a thing about it. And by 2009, I could have, it was a full-time income. I didn't quit the law then. I did both for a while, but yeah. So that was it. That's why I created Dough Roller. This is interesting. So this is, Steve, is this an update on the Vanguard in-kind transfer debacle? You're transferring 188 stocks? I confess I've never done that. Still think they should be able to do it, but that is a lot of positions. Lee says, my holding of VWUSX had a huge drop in the middle of December. Could you explain what happened? Sure, I can try. I don't know. Without looking at anything, my guess would be some sort of dividend payment. But that's just a guess. So let's see if we can solve this riddle. we'll start with, man, Morningstar is just being grumpy today. Here we go. VWUSX. Vanguard US Growth Investor. Here it is. This is probably not going to answer the question. So it's obviously gone down. And it looks like the drop started in December, actually, but fell off a cliff in January. So I don't know, that could be it. But what I wanted to see was distributions. So it had a massive, is that massive? It sure looks massive compared to these. Long-term capital gains distribution. And my guess is that most of it occurred in December of 2021, because that's when most of these are distributed. And yep, here we go. So $7 and, we'll call it 14 cents in long-term capital gains. So that's over 10% of the NAV. Now, what did you say? Oh, you didn't get, I was looking to see if you said the amount. But and that was December 15th, middle of December. I think we have a winner. That's my best guess. Unburdened by any actual knowledge of the situation, and unburdened by really any understanding of the intricacies of how a mutual fund distributes capital gains. I'm really unburdened by a lot of things. That'd be my guess, Lee. Yeah. Why they had that? Vanguard. I don't know. I don't know what happened. We could probably figure that out. If you just Google VW, why did VWUSX distribute so much freaking capital gains? I guess we can maybe take out some of the language. Cap gains in December 2021. I don't know. I'm not seeing anything obvious. And there's some articles, but nothing specific to that fund. But that's my hunch is, Lee, that it's those capital gains distributions. All right, it's 8:23. I'm going to just start. Let's see what I can, some rapid fire questions. I don't know. So this is a tough question from Patrick. His wife can either have $140,000 added to her pension, which gives an extra $675, or invest the $140 yourself. First of all, if you're not comfortable making this decision on your own, I would speak to a financial advisor who can just give you hourly advice. Don't talk to someone who wants to manage your money, because if you think about that, for a fee, assets under management, because what are they going to tell you? Well, they're going to want your 140 grand to invest for you, because that's going to make them money. And I don't say that to suggest that those that charge a percentage of assets under management are just some, only out for themselves, but there is an inherent conflict of interest. So I would speak to someone who can just do, an hourly thing. The way the pension works, I'd want to understand that. So for example, if she were to pass away, would you get some amount of that, for your life? With 140, it's yours. You control it. I say you, your wife controls it. If you were both to die, then it could be inherited. A pension, I don't know if there are any sort of weird pension riders where some amount can be inherited, maybe, I don't know, but by and large, not. So, those, are you comfortable investing it? Or is she comfortable investing it? So there's sort of a lot of questions. Some of them are sort of math investing questions, and some of them are just emotional, behavioral. Would you prefer the comfort of a pension? What do your other assets look like? So there's sort of a lot of factors I would be thinking about. There's certainly advantages to a pension, because you're much more likely to spend that $675 a month, because that next month another check's coming in, right? Whereas for all the reasons we talked about at the top of the show with inflation and everything, we tend to get real conservative when it comes to spending our investments. That's scary. But spending a Social Security check or an annuity check or a pension check, not scary at all, because money comes in the next month. And so that's an advantage, I think, of a pension. So this is not an easy question. Now, there will be a break-even analysis that they can do for you, or an advisor can do, that says, the pension will be better if you live to be X years old. But I don't know how helpful that is. I mean, I guess it's an important point to know, but, how do we know, how long we're going to live? Is the pension adjusted for inflation? That would be a question I'd have. Okay, that's the best I can do. Hopefully that's helpful. It's a good problem to have. So King Ming wants to know, just how beneficial is tax loss harvesting? I invest part of my funds with Betterment. It had a 30% plus gain for the past 6 years until now. I keep seeing email that they help reduce my tax liability. Well, you should see that in the tax forms that they send you at the end of the year. If they're doing some tax loss harvesting, it could come up in a couple of ways. If they're rebalancing and there are some gains, then maybe they get offset by the losses. But you should see that benefit in your tax documents, right? Because you can offset losses, you can offset gains with your losses, and then if you still have losses, you can deduct up to 3,000 of them that year against, say, ordinary income. And if you have even more losses after that, you can carry them forward. I'm not a tax expert, but that's my understanding. I generally think that the tax loss harvesting benefits promoted by robo-advisors sometimes it can be overstated. I don't mean like some sort of intentional misleading, but I'm not convinced that the tax loss harvesting is necessarily a huge perk long term. If you invest a lump sum, maybe, but I look at my investments and I think I don't know. But in any event, yeah, it can be, I've taken some tax loss harvest. I've done some tax loss harvesting this year, and it's been very beneficial for me. By the way, I haven't shown you my credit card rewards balance for a while. And there's a reason for that. I've moved it out of M1 because I had it in there for a number of months, maybe even a year. And it gave me a chance to understand that platform and use it. Now I'm moving it over to Betterment. I'm going to try Betterment out for a bit. So once I get it moved over there, I will show it to you. And I will tell you if I like Betterment or not. I'd thought about moving it over to Vanguard's digital advisory service, but if you've watched that video, I wouldn't recommend someone avoid it per se, but it had a lot of issues. I wasn't thrilled with it. Anyway, all right. Man. Is 200 grand a good number to slow down my contribution and let compound interest take over? I'm 36. Well, that would be Coast Fire, right? Coast Financial Independence, Retire Early, where you get to a point where you don't have to contribute anymore. You can just coast and let compounding take over and then retire at some point in the future. But it depends on your goals. If you want to retire at 40 or 45, you probably want to keep contributing, or 50. If you wanted to retire at 65, you just have to do the math. We could look at a future value calculation. You have to assume a rate of return. But it really just depends on your goals. There's no answer to that. Part of my question would be, what are you going to do with the amount of money you would have contributed? Which may seem silly. It's like, well, I want to spend it. I've got all kinds of fun things I want to spend it on. Maybe you do. I don't know. But there's really no answer to that. I generally think it's a good idea to save something out of every paycheck. I feel so old-fashioned saying that. It's just so uncool these days. But that's how I feel. All right. BV wants to know, They're gonna change their target date funds so they're gonna move out of target date into index funds. And it's in a retirement account, so we don't have to worry about taxes. Can I do it anytime or at the downtime? Anytime. I mean, assuming you're not changing your asset allocation, you're just changing from a target date to individual index funds. There's no reason I don't see any reason to not do it now versus some other time. And how are you going to know when it's a downtime? I mean, you'll know after the fact. We'll be able to look back and say, oh, that was a downtime. But how do we know? It's like when people say, I'm buying the dip. I want to say, how do you know? How do you know you're buying the dip? Maybe you're buying the peak, or at least the peak as of today. You don't know if you're buying the dip. Yeah, see, it's losing those speed chess games. It really, I don't know, set the tone for the whole show. So I don't think an inverse ETF is a good idea ever, generally. But what you're basically betting is that the market will continue to go down. And I don't have any idea if that's true or not. If it continued to go down and interest rates continue to go up, I don't think that would surprise anyone. But I have no idea. And so because of that, it's just not, it's like shorting stocks. I just don't do it. Okay. Here's one. Learn from experience. My wife regretted her non-term life insurance purchase, cashed out. Yeah. It really burns me up when I see these TikTokers advertising. They're salespeople. They're insurance salespeople trying to convince you that some expensive permanent life insurance with cash value is better than like a Roth IRA. I think it's ridiculous. All right. Isn't Empower, they own Personal Capital, right? Am I thinking of the right company? Yeah, an Empower company. So Empower owns Personal Capital. I don't know how that's relevant. Well, the bigger question for me, David, and Fidelity is a great broker. If I had to pick like the best traditional broker, probably be Fidelity. I mean, there's a lot of good ones. Don't get me wrong, but in any event, the real question though is going to be what funds they offer, right? If they offer some good low-cost index funds, I think you're set. I think. I don't know what their website is like. I mean, obviously, Personal Capital, I think, is a great website for tracking all your spending and investments, but I've never had an Empower 401k. Empower Retirement. Yeah, I don't know. But as long as they have low-cost index funds, I think you're okay. Steven wants to know, and I know I'm already over time, but you guys asked some good questions. Why does Treasury Direct make it seem like one can get yield on short-term bills, but all the funds are down X percent? Well, it's a great question. Now, when you say all of the funds, it depends what funds you're looking at, but probably even the short term. So doesn't Schwab have, but there's an answer to your question, I think. Or at least I'll give you my answer, but let's look up a fund first. Schwab Treasury Bill ETF. If I could spell Treasury Bill ETF. So SCHO. So here's SCHO. This is just one example. I guess you get a boat with this fund. No, I'm just kidding. You don't really, so don't expect a boat. In any event, SCHO, cheap, 4 basis points. Performance this year. What happened? All right, Schwab. What is going on with your website? Let's try that again. Huh. Okay. Well, that gave me a headache. We'll go to Morningstar. I'm starting to think this is user error. But I can't imagine what I've done wrong. All right, so we go to performance this year. And yeah, it's all 351. Okay, now let's go over to Treasury Direct. There's an answer to this, by the way. And actually, before we look at Treasury Direct, one thing to look at here on the quote page is, notice this. This is interesting. The 12-month yield is 40 basis points. The SEC yield is 248. What in the world's going on? Well, as the name suggests, this is the yield over the last 12 months. We can even, the sum of investments total trailing 12-month interest and dividend payments, right? Divided by the last month's NAV, net asset value. The SEC yield is the yield over the last 30 days. It's annualized, I should say. It's an annualized yield based on the last 30 days. So why is this so much higher than this? Well, interest rates have gone up, right? That's why. And let me make sure you guys can see. Can you see all this? Yeah. And that's why a lot of times, if interest rates were sort of flat and hadn't moved much, the SEC yield and the 12-month yield would be the same or similar. All right. Now let's go over to the Treasury Direct website. This is, the 1990s called. They want their website back. And let's see here. Interest rates. I don't want any of that. Well, we'll go to the individual tab. And Treasury bills. Here we go. And I want to find, looking for interest rates. They have it somewhere. You guys can probably all see this and you're yelling. It's there, Rob. It's top left. Just click the stupid link. All right, hang on. We'll just look it up. Treasury bill yields. All right. Yeah, that's not going to be what we want. Here we go. Maybe this will tell us. No, it doesn't. Well, in any event, oh, here we go, auctions. Well, I can just tell you the answer is that when you're buying a Treasury bill today, you're getting the current yield, which has gone up, right? Because interest rates have gone up. The performance you see on a fund, and I hope I'm answering your question, the performance you see on the fund is the effect of that fund owning Treasury bills, let's just say at the beginning of the year, interest rates going up, so the Treasury bills they own, their values went down. And that's why you're seeing a negative, whatever, 3%, let's say. Again, over time, they'll benefit from the increase in yields, but that doesn't happen overnight. If you go into Treasury Direct, apparently in a way I can't seem to find, you would get the current yield today. You're buying an individual bond, you'll get whatever the yield is today. You can still lose money, it's just not in the same way. If you buy a Treasury bill today that's yielding, I don't know what they're yielding, let's just say it's 1%, and rates go up, the value of that bond goes down. Now, you may not see it, right? It's not like being repriced like an ETF is every day, but you're stuck. Now, you're stuck for a short period of time because these are short-term bonds, but you're stuck at that 1% while everyone else is driving around with 1.5% Treasury bills, pointing their finger at you and making fun. Or, you get the idea. It's just that loss doesn't show up, in a line item on your portfolio because it's a single bond that you own. You're presumably not selling it. But I'm aggravated that I can't see the rate. Rates and terms. There they are, but they don't actually give them to you. I've seen this before. Anyway, I'll stop looking because it's already now 8:39. Okay, I'm going to still look at a few other questions. No, I think, so the 4% rule is not relevant anymore. I think what you mean is, will the 4% rule still work? As of now, I believe it will. But could the future change that? Sure. Right? I think the biggest issue is inflation, actually, not market returns. They're both important, of course. But I think we're still a long way from having events similar to what happened in the 70s. we could go down that path. But again, I don't think most people actually adjust their spending the way Bill Bengen did in his paper that gave us the 4% rule. So in that sense, I think we put it another way, I think we have far more control. In a sense, the 4% rule gives you zero control. You just blindly follow the rule. People just don't do that. I don't think. Anyway, hope that helps answer that. Yeah. All right. I believe this is true. Betterment's default portfolio is weighted towards value. I don't know. Wealthfront might be as well, though. But the thing is with Betterment, you can customize. You can create your own portfolio effectively, which is really cool. You couldn't always do that. And I'm actually opening. I'm going to show you my account, which at the moment has $0 in it. Always use two-factor authentication, which I'm trying to pull up here. Okay, let me, I'll show you this in a second. Well, this is not what I wanted. Maybe this will do it. No, not what I wanted. Oh, here we go. Maybe. Nope. This is, I'm telling you, losing those chess games. Here we go. So, yeah, here's their standard portfolio. This is not how I would invest it, but you can see they've got U.S. value small cap, U.S. value large, then they've got total market. So, you know, the weight that they're using, they're not like significantly overweighting to value, but there's definitely some value tilt. There's value tilt here in the mid cap. So there's some tilt to value, not huge, I don't think. And you can change all that. So Wealthfront, I used Wealthfront back in the day for a SEP IRA. This was years ago. And I still have my account there. Again, it doesn't have any money in it. But I wanted to look at their sort of basic portfolio. I guess it's not tilted towards value. It's actually tilted towards growth. I'll show you this. They have some dividend growth stocks. Oh, no, that's not tilted towards growth. That's Vanguard Dividend Appreciation, VIG. That might actually be tilted towards value. Although I don't think so, actually. It's probably a blend. What do I know? Yeah, it's a blend. So yeah, they don't tilt theirs. But again, with Betterment, you get your choice because you can customize it. Whew. All right. Well, we made it through tonight, and I appreciate you guys hanging in there. Next week, I will try to do better on the chess game, the pre-show chess games. Try to maybe win one. So I am interviewing Mark Sorrell this Wednesday at 8 a.m. live. I've gotten all your questions. There was a technical issue on Mark's end. They were doing something with his high-speed internet, and he didn't have it. So anyway, this Wednesday, 8 a.m. in the morning. If you can't make it, you can obviously watch it. It'll be up on YouTube. And we're going to basically cover questions for expats. We had some interesting exchanges. He goes, Rob, one thing I want to share with you. All of these issues, they're really not as hard as they may seem at first. I think it was his way of saying, I'm not sure we can fill up, a long interview. This stuff isn't really that difficult. I guess we'll find out. This is an area, I've never lived overseas. So, I've traveled, of course, but I've never lived in another country. So I've never had to deal with these issues. So it's something I really know nothing about. So I'm actually looking forward to it just out of interest. but I know this is an important issue to a lot of you, or maybe someone you know, right? So that'll be 8 a.m. on Wednesday. And then on Friday, of course, I'm going to review the Avantis mutual funds. Come hell or high water. That's the plan. So there you go. Thanks for joining. Hope you found something useful out of tonight's show. And next week, are we doing Monday next week? There's going to be some weeks when I can't do Mondays, but that's not next week. It's the week after. I'm not going to be doing this Monday, 4th of July. But next week, again, Lord willing and the creek don't rise. Next Monday, the 27th at 7 p.m., I will be back here answering questions. Maybe what I'll do is just not play any speed chess games right before the show. Maybe that's what I need to do. I am playing in the World Open in Philadelphia, so that'll be fun. Yeah. All right, I'm done talking. Have a great week. Until next time, remember, the best thing money can buy is financial freedom. How do I turn this thing off?